Think about the last time someone bought a house in America. Maybe it was you. Maybe it was your parents. Or maybe it was someone you know who sat across from a loan officer, signed a mountain of paperwork, and walked away with a promise to pay for that home over the next 30 years. 30 years. Long enough to raise a child from the day they're born until the day they graduate college. Today, that feels completely normal. We rarely stop to question it. The 30-year fixed-rate mortgage feels as permanent as the Constitution itself, like something America has always had, like it was simply waiting to be discovered. But none of that is true. For most of American history, there was no 30-year mortgage. There wasn't even anything close to it. If you wanted to buy a home, you either needed to be wealthy enough to pay cash or brave enough to take a financial gamble that could wipe out your entire family's future. Imagine spending years making every payment on time, watching your children grow up inside that house, believing you were slowly becoming a homeowner. Then one morning, your lender arrives and calmly tells you something almost unimaginable today. Your loan has expired. You now owe every remaining dollar immediately. If you couldn't pay, you lost everything. That wasn't unusual. That was how home buying actually worked. And it raises an uncomfortable question. If America's most famous financial product didn't exist, how did millions of Americans ever manage to own homes? More importantly, what went so catastrophically wrong that the federal government decided it had to completely reinvent the way an entire nation finances shelter? Because the story you're about to hear isn't really about mortgages. It's about power. It's about land. It's about financial innovation born from desperation. It's about one of the worst economic disasters in American history. And it's about a system that created the modern American dream while simultaneously locking millions of Americans outside the front door. The 30-year mortgage wasn't handed down by nature. It wasn't created by banks acting alone. It was invented, built piece by piece, during one of the darkest moments the United States had ever faced. And once you understand how it happened, you'll never look at your monthly mortgage payment the same way again. But to understand why America had to invent the modern mortgage, we first have to go back to a time when banks weren't even in the home loan business. For most Americans today, buying a home begins with a bank. You compare interest rates, fill out an application, wait for approval, and if everything goes well, you spend the next 30 years paying off your mortgage one monthly payment at a time. It's such a familiar process that it's easy to assume it has always worked this way. But for the first several decades of American history, banks weren't even the center of home ownership. In fact, they barely played a role at all. To understand how Americans first became property owners, you have to forget everything you know about mortgages and imagine a country that possessed something almost impossible to comprehend today: land, an almost unimaginable amount of it. When the Revolutionary War ended, the new United States government suddenly controlled millions upon millions of acres, stretching westward beyond the original 13 colonies. The young republic had won its independence. Now it faced an entirely different challenge. What should it do with all that land? That question wasn't simply about geography. It was about money, power, settlement, and ultimately about who would have the opportunity to build wealth in the new nation. The government's first serious answer arrived with the Land Ordinance of 1785. On paper, it looked brilliantly organized. Surveyors divided enormous territories into perfectly measured townships. Each township was then divided again into 36 sections of 640 acres. For the federal government, the system brought order to what had once been wilderness. For ordinary Americans, however, it solved very little. Because while the land had finally been mapped, it still wasn't affordable. The minimum parcels were enormous. The prices remained far beyond what most working families could hope to save. The system favored the people who already had capital: large investors, land speculators, wealthy businessmen. They could afford to buy massive tracts of frontier land, hold them, and later sell smaller pieces at a profit. The farmers who actually wanted to settle that land often found themselves priced out before they had even begun. Congress eventually tried to make ownership easier. By 1800, the minimum purchase size was reduced, and buyers were allowed to spread payments over several installments. It sounded like progress, but the reality barely changed. Even at $1.25 per acre, purchasing hundreds of acres required resources that most laborers simply didn't possess. For families surviving on modest wages, legal ownership remained almost as distant as ever. So countless Americans stopped waiting for permission. Instead, they headed west anyway. They found open land, built rough cabins with their own hands, cleared forests, planted crops, raised livestock, and hoped that when government surveyors finally arrived years later, their labor would count for something. It was risky, sometimes illegal, often uncertain, but for many early settlers, it represented the only realistic path toward owning property. In those years, homeownership wasn't created by financial contracts. It was earned through physical endurance. Every acre had to be cleared. Every fence had to be built. Every winter had to be survived. Ownership came after years of proving that you belonged there. Then, in the middle of America's bloodiest conflict, the rules changed forever. In 1862, while the Civil War was still raging, President Abraham Lincoln signed one of the most consequential pieces of legislation in American history, the Homestead Act. Its promise was astonishingly simple. Any eligible adult willing to live on public land, improve it, and remain there for 5 years could receive up to 160 acres for little more than a small filing fee. Suddenly, millions of acres that had once been accessible only to wealthy investors became available to ordinary families. Over the next century, more than 270 million acres would pass from federal ownership into private hands. Entire farming communities appeared where open prairie had once stretched to the horizon. Small towns emerged. Railroads expanded. The American West began to fill with families chasing opportunities that previous generations could scarcely imagine. For rural America, this transformed the meaning of ownership. But even this revolutionary law left one enormous question unanswered. The Homestead Act worked because land was abundant on the frontier. It offered farms, fields, open space. But by the late 19th century, America was changing. Millions of people weren't moving west anymore. They were moving into cities. Factories were replacing farms. Brick row houses were replacing log cabins. The challenge was no longer claiming 160 acres. It was buying a modest home on a crowded city street. And there, the old problem returned. Because without today's mortgage system, owning a house in urban America was about to become far more difficult than anyone expected. For city families, the frontier was gone, and the only thing standing between them and homeownership was a financial system that seemed designed to keep ordinary people out. By the end of the 19th century, America had become two very different countries. Out on the frontier, families could still dream of claiming land through hard work and perseverance. But inside America's rapidly growing cities, that dream looked completely different. People weren't looking for 160 acres anymore. They wanted something far smaller, a modest house, a narrow lot, a place close enough to the factories where they worked every day. The Industrial Revolution was transforming cities at an astonishing pace. New York, Philadelphia, Boston, Chicago, Cleveland. Millions of immigrants and rural workers poured into these urban centers, searching for opportunity. But while jobs were becoming easier to find, owning a home was becoming harder than ever. If you wanted to buy property in the city, you usually faced one of only two choices. The first option was brutally simple. Pay cash, every dollar, up front, no financing, no monthly payments, no bank helping you bridge the gap. Needless to say, very few families could do that. The second option sounded more promising, borrow the money. But what Americans called a mortgage before the 1930s looked almost nothing like the mortgage people know today. In fact, by modern standards, it barely resembled one at all. First came the down payment. Today, many buyers think saving 10 or 20% is difficult. At the beginning of the 20th century, borrowers were often expected to put down half the value of the house, sometimes even more. Imagine finding a modest home worth $4,000. You couldn't simply save a few months' salary and apply for financing. You needed $2,000 before a lender would even consider talking to you. For an average worker earning only $400 or $500 a year, that wasn't merely difficult. It was almost mathematically impossible. A family would have needed to save nearly every dollar they earned for years just to reach the front door of the lending process. And even if they somehow achieved that impossible goal, the real gamble was only beginning, because these loans were astonishingly short. 3 years, 5 years, sometimes 10, rarely longer. But the length of the loan wasn't the biggest surprise. It was how the payments worked. Month after month, borrowers faithfully sent money to the lender. Many believed they were slowly buying their homes. They weren't. Those monthly payments covered only the interest. The original loan amount remained almost completely untouched. Then, when the loan term ended, reality arrived all at once. The lender demanded every remaining dollar immediately, the entire principal. In one payment, this was known as a balloon payment. The name almost sounds harmless. The experience certainly wasn't. Imagine raising children in a house for 5 years, paying every monthly bill exactly as agreed, maintaining the property, believing you were building a future. Then one day, your lender calmly informs you that you now owe the full amount of the original loan, not over the next 20 years, not over the next 10, today, right now. Most families simply couldn't produce that kind of money. Their only hope was refinancing if another lender agreed, if credit remained available, if the economy stayed healthy, if property prices continued rising. Too many ifs. And whenever one of those conditions disappeared, everything collapsed. Families lost homes they had spent years trying to keep, not because they ignored their payments, but because the system itself was built around a deadline almost no ordinary household could meet. Owning a home wasn't a stable achievement. It felt more like balancing on the edge of a cliff. You could spend years believing you were safe, only to discover that one financial shock could erase everything. This constant uncertainty created a cycle of instability across the housing market. People delayed buying, others postponed starting families. Many accepted renting for life because ownership seemed permanently beyond their reach. For millions of working Americans, the greatest obstacle wasn't a lack of determination. It was a financial system designed for people who already possessed wealth. And yet, just when homeownership appeared trapped behind impossible barriers, a completely different idea began spreading across the country. It didn't come from Wall Street. It didn't come from Washington. It came from ordinary neighbors who believed that if banks wouldn't help working families, perhaps working families could help each other. That simple idea would become one of the most remarkable financial experiments in American history. For all its flaws, the old housing system wasn't entirely controlled by banks. Long before Washington stepped in, long before the FHA, long before the 30-year mortgage, ordinary Americans had already begun experimenting with a different idea. What if families could finance each other's homes? Instead of waiting for wealthy lenders to decide who deserved a mortgage, what if neighbors pooled their own savings? It sounds surprisingly modern, but in the early 19th century, it was revolutionary. The first successful experiment appeared in 1831. It was called the Oxford Provident Building Association, founded in Frankfort, Pennsylvania. Its idea was remarkably simple. Every member contributed money into a shared fund. Nobody entered as a customer. Nobody entered as a borrower. Everyone entered as both an owner and an investor. As the pool of savings grew larger, members could begin borrowing from it. One family would receive a loan to build or buy a home. They would repay it over time. Those repayments replenished the common fund, allowing another family to borrow next, then another and another. Instead of profits flowing to distant investors, the benefits stayed inside the community. Working families financed other working families. The system depended on trust rather than enormous amounts of capital, and for thousands of Americans it worked. Better yet, these associations quietly solved several of the biggest problems that traditional mortgages had created. Unlike commercial banks, they weren't obsessed with short-term lending. Instead of forcing borrowers into 3- or 5-year loans followed by devastating balloon payments, many building and loan associations stretched repayment periods to 8 or even 12 years. That may not sound extraordinary today. At the time, it changed everything. Even more important was how the payments worked. Each monthly payment wasn't simply covering interest. Borrowers were gradually paying down the principal as well. Every payment brought them one step closer to genuine ownership. For the first time, many ordinary Americans weren't merely renting the idea of owning a house. They were actually building equity month after month. It was a profound shift, one that made homeownership feel achievable instead of temporary. Not surprisingly, the idea spread with astonishing speed. Throughout the late 19th century, thousands of building and loan associations appeared across the United States. Almost every growing town seemed to have one. They became deeply woven into local communities. Members attended meetings, voted on decisions, shared responsibility for the organization's success. They weren't anonymous financial institutions. They were neighbors helping neighbors. By 1930, their influence had become enormous. According to the transcript, they counted 12.3 million members, controlled nearly $9 billion in assets, and financed roughly 1/3 of all home mortgage debt in America. If you were a working-class family, fortunate enough to own a house before the Great Depression, there's a good chance a building and loan association helped make it possible. Their importance became so deeply embedded in American culture that decades later they inspired one of the most beloved financial institutions ever portrayed on film. The Bailey Brothers Building and Loan in It's a Wonderful Life wasn't pure Hollywood fantasy. It reflected something. These organizations represented hope at a time when conventional banking often excluded ordinary families. But even they couldn't overcome every obstacle. Despite their remarkable success, homeownership remained frustratingly out of reach for much of the population. By 1900, fewer than half of American households owned the homes they lived in. Many families still crowded into rented apartments, boarding houses, tenements. Industrial cities continued growing faster than affordable housing could keep pace. The American dream remained exactly that, a dream. Then, during the 1920s, something remarkable happened. For the first time in decades, it seemed as though homeownership might finally become a reality for millions of Americans. The economy boomed, credit became easier, optimism spread across the country. Families borrowed more confidently than ever before. Builders raced to keep up with demand. It looked like the beginning of a golden age. But beneath that optimism, the same dangerous foundations were still there. Short-term loans, balloon payments, excessive borrowing. A housing market built on the assumption that tomorrow would always be better than today. And history has a habit of punishing that kind of confidence. The prosperity of the Roaring Twenties wasn't building the American dream. It was quietly building one of the greatest housing disasters in American history. For a brief moment, it looked as though America had finally solved its housing problem. The 1920s became known as the Roaring Twenties for good reason. Factories expanded, consumer spending exploded, stock prices climbed year after year. Automobiles rolled off assembly lines in record numbers. Electricity reached millions of homes. Optimism seemed limitless. Americans weren't just buying radios and refrigerators, they were buying houses. Developers rushed to build new neighborhoods. Banks became increasingly willing to lend. More families entered the housing market than ever before. To many observers, homeownership finally appeared within reach of the average American. But underneath that optimism, very little had actually changed. The houses were new, the neighborhoods were larger, the economy was booming, yet the mortgage system itself remained dangerously fragile. Borrowers were still relying on short-term loans. Most were still making interest-only payments, and millions still expected to refinance before the dreaded balloon payment arrived. The entire system depended on one assumption, that tomorrow would always be better than today. As long as home prices continued rising, as long as banks remained confident, as long as credit stayed available, the machine kept running. But financial systems built on confidence often appear strongest just before they break. By the end of the decade, Americans had accumulated unprecedented levels of mortgage debt. According to the transcript, total residential mortgage debt nearly tripled during the 1920s. That rapid expansion wasn't necessarily a sign of a healthy market. It was a sign that more and more families had become dependent on constant refinancing. The system no longer required just responsible borrowers. It required permanently favorable economic conditions. Then, in October 1929, everything changed. The stock market crashed. At first, many believed the damage would remain confined to Wall Street. It didn't. Businesses failed, Factories reduced production. Workers lost jobs. Consumer confidence disappeared. Banks suddenly became far more cautious about lending money, and that's when the hidden weakness inside the mortgage system finally revealed itself. Families who had expected to refinance their balloon loans discovered that refinancing was no longer available. Banks that had eagerly issued loans during the boom were now struggling to survive themselves. Credit dried up almost overnight. Borrowers reached the end of their loan terms, only to discover there was nowhere left to turn. The balloon payments still came due, but the money simply wasn't there. One family defaulted, then another, then another. Foreclosures spread through cities and small towns alike. Each foreclosure pushed property values even lower. Falling property values weakened banks. Weak banks made fewer loans. Fewer loans produced even more foreclosures. The cycle fed itself. What had begun as a housing slowdown became a nationwide financial collapse. By 1933, the numbers were almost impossible to comprehend. Nearly half of all home mortgages in the United States had fallen into default. Around 1,000 American families were losing their homes every single day. More than 9,000 banks had failed. Unemployment climbed to roughly 25%. Entire communities watched neighbors pack their belongings and leave houses they had spent years trying to keep. Building and loan associations suffered alongside commercial banks. Many had been created to help working families achieve stability. Now they found themselves overwhelmed by defaults, shrinking deposits, and collapsing real estate values. Organizations that had once symbolized community cooperation suddenly faced the same harsh economic reality as everyone else. For millions of Americans, the dream of homeownership didn't simply fade, it collapsed. Perhaps the cruelest part was that many families had done exactly what they were supposed to do. They worked, saved, made payments, honored their obligations. Yet they still lost everything because the financial system beneath them had failed. By the time Franklin D. Roosevelt entered the White House in 1933, the crisis had grown far beyond individual homeowners. This was no longer just a housing problem. It was a banking crisis, an employment crisis, a confidence crisis. The entire American financial system was becoming trapped in a downward spiral. And for the first time in the nation's history, many leaders reached a conclusion that would have seemed almost unthinkable only a few years earlier. Perhaps the private market could not solve this disaster on its own. Perhaps the federal government would have to step in, not simply to rescue homeowners, but to reinvent the entire mortgage system from the ground up. The solution that followed wouldn't just save the housing market, it would permanently redefine how Americans buy homes for the next century. By 1933, it had become painfully clear that America's housing crisis wasn't going to fix itself. For generations, the country had relied on private lenders, local building and loan associations, and short-term mortgages to finance homeownership. Now that entire structure was collapsing. Banks were failing. Credit had disappeared. Families were losing homes by the thousands. And perhaps most alarming of all, even people who had done everything right were still ending up in foreclosure. The old system hadn't simply failed during the Great Depression. The Depression had exposed weaknesses that had always been there. For decades, the American mortgage market had depended on constant refinancing. As long as property values kept rising and lenders kept issuing new loans, the system appeared stable. But once that chain broke, everything unraveled. President Franklin D. Roosevelt understood that rescuing individual homeowners would not be enough. The country needed something much larger. It needed an entirely different mortgage system, one that ordinary families could actually survive. One of the first major steps came in 1933 with the creation of the Homeowners Loan Corporation, better known as the HOLC. Its mission wasn't to hand out brand new mortgages. Instead, it focused on families already trapped inside the old system. Thousands of homeowners were approaching balloon payments they had no hope of paying. Others faced immediate foreclosure because banks refused to refinance their loans. Holk stepped in and bought many of those troubled mortgages from private lenders. Then it offered homeowners something they had rarely seen before, a completely different kind of loan. Instead of demanding repayment within just a few years, Holk refinanced those mortgages into much longer repayment schedules. Instead of forcing borrowers to pay only interest and then face one enormous balloon payment, the new loans required regular payments that gradually reduced both interest and principal. For the first time, millions of Americans could actually watch their debt shrink month after month. Today, we call that amortization. At the time, it felt revolutionary. A mortgage was no longer a ticking clock waiting to explode. It became a predictable path toward ownership. According to the transcript, Oak refinanced nearly 1 million mortgages before the program ended. That alone saved countless families from losing their homes. But Roosevelt's administration knew refinancing existing loans wasn't enough. America also needed a way to prevent the next housing collapse. That led directly to one of the most influential financial institutions in American history. In 1934, Congress created the Federal Housing Administration, or FHA. Unlike Hulk, the FHA didn't lend money directly to homebuyers. Instead, it did something much smarter. It insured mortgages issued by private lenders. That single decision changed the entire calculation for banks. Before FHA insurance, lending money for home purchases involved enormous risk. If borrowers defaulted, lenders absorbed much of the loss. Naturally, banks protected themselves by demanding huge down payments and offering only short-term loans. FHA insurance dramatically reduced that risk. If a qualified borrower failed to repay the loan, the government would cover much of the lender's losses. Suddenly, banks could afford to think differently. Instead of demanding 50% down, they could accept far smaller down payments. Instead of issuing loans lasting only 3 or 5 years, they could offer mortgages extending 20 years and eventually even longer. Most importantly, instead of forcing borrowers into devastating balloon payments, lenders increasingly adopted fully amortized loans with fixed monthly payments. For ordinary Americans, the difference was life-changing. Families no longer had to spend years wondering whether refinancing would still be available when their loan expired. Every payment moved them closer to owning their home outright. Every month reduced the balance. Every year brought greater security. It fundamentally changed the psychology of homeownership. Buying a house was no longer a short-term financial gamble. It became a long-term family investment. Yet, even after the FHA transformed the way mortgages were written, another enormous obstacle remained. Banks were now willing to make longer loans. But those loans tied up their money for decades. If every mortgage lasted 20 or 30 years, how could lenders continue making new loans to new families? Without another breakthrough, the system would eventually run out of money all over again. America had reinvented the mortgage. Now, it had to reinvent the flow of capital itself. The next innovation wouldn't change how Americans borrowed money, it would change how banks financed an entire nation of homeowners. By the mid-1930s, America had solved one enormous problem. Homebuyers finally had access to safer mortgages. Loans lasted longer, monthly payments became predictable, balloon payments gradually disappeared. Families could realistically expect to own their homes one day instead of constantly fearing the next refinancing deadline. But a new problem immediately emerged, one that most homeowners never even thought about. Where would the money come from? Imagine you're a local bank in 1935. A young couple walks through your front door. You approve their mortgage. Under the old system, your money would likely return within 3 to 5 years. You could lend it again and again. Now imagine that same loan stretches 20 years or 30. Your money is tied up for decades. Every mortgage you approve leaves you with less cash available for the next family. Even the safest mortgage in the world becomes a problem if every dollar remains locked away for a generation. Without another solution, banks would eventually stop lending, not because families weren't qualified, but because lenders would simply run out of capital. The new mortgage system needed something more than safer loans. It needed liquidity. That breakthrough arrived in 1938. The federal government created the Federal National Mortgage Association, better known today as Fannie Mae. Unlike the FHA, Fannie Mae didn't insure mortgages. Its purpose was entirely different. It created something America had never truly had before, a secondary mortgage market. The concept was surprisingly elegant. A local bank would approve a mortgage for a qualified family. Instead of waiting 30 years to recover its money, the bank could sell that mortgage to Fannie Mae. The bank immediately received its cash back. With fresh capital in hand, it could turn around and finance another family, then another, then another. The mortgage didn't disappear, only its ownership changed. The homeowner continued making the same monthly payment, the same interest rate, the same schedule. Behind the scenes, however, the financial system had become dramatically more efficient. Banks no longer needed to choose between helping today's borrowers and tomorrow's borrowers. They could do both. For the first time, home lending became scalable on a national level. Money no longer remained trapped inside thousands of local banks. Capital began flowing across the country. Regions with excess savings could now help finance homes in rapidly growing communities hundreds or even thousands of miles away. What had once been a collection of isolated local lending markets slowly evolved into a truly national housing finance system. Combined with FHA insurance, the secondary market transformed the economics of homeownership. Lenders faced less risk. Borrowers gained access to longer loans. More families qualified. Construction accelerated. Developers gained confidence to build larger neighborhoods. The foundation of modern American housing was finally taking shape. Yet one piece was still missing. The system had become safer. It had become larger. It had become more efficient. But it had not yet reached the millions of young Americans who were about to return home from the largest war the world had ever seen. When World War II ended, the United States faced another challenge, unlike any in its history. Millions of veterans were coming home. They wanted jobs. They wanted families. And above all, they wanted homes. The mortgage system was finally ready. Now America was about to discover what happened when an entire generation gained access to it at once. The greatest expansion of homeownership in American history was about to begin, and it would reshape the country in ways few could have imagined. When World War II ended in 1945, the United States faced a challenge unlike anything it had experienced before. More than 16 million Americans had served in the armed forces. Now they were coming home. They needed jobs, they needed schools, they needed to rebuild their lives. And perhaps most urgently, they needed places to live. The country had spent years focused almost entirely on wartime production. Factories built tanks instead of houses. Steel went into battleships instead of suburban neighborhoods. Construction slowed dramatically during the war. By the time peace arrived, America was facing an enormous housing shortage. Millions of young veterans wanted to get married, start families, and buy homes. But demand alone wasn't enough. Without affordable financing, those dreams could easily have become another housing crisis. Fortunately, the mortgage system created during the New Deal was already in. Now, the federal government expanded it even further. In 1944, even before the war officially ended, Congress passed what became known as the GI Bill. Many people remember the GI Bill because it helped veterans attend college. But another part of the legislation proved just as transformative. It made homeownership dramatically easier for millions of former service members. Under the program, qualified veterans could receive government-backed home loans with extraordinarily favorable terms. Many required little or no down payment. Interest rates were lower. Repayment periods were longer. For families who only a generation earlier would have struggled to save half the value of a home before even applying for a loan, the difference was extraordinary. For the first time in American history, millions of middle-class families could realistically imagine buying a home shortly after starting their careers. The impact was immediate. By 1955, according to the transcript, more than 4.3 million home loans had been guaranteed through the GI Bill. Entire neighborhoods seemed to appear almost overnight. No place symbolized this transformation more than Levittown, New York. Developer William Levitt approached housing the way Henry Ford had approached automobiles. Instead of treating every home as a unique project, he standardized construction. Crews repeated the same tasks over and over. Materials arrived in carefully planned sequences. Efficiency replaced custom craftsmanship. The result was astonishing. Thousands of nearly identical houses could be built quickly and sold at prices many working families could finally afford. For countless Americans, Levittown became the physical image of post-war prosperity. A detached home, A front lawn, a driveway, children playing outside, neighbors who had all arrived with similar hopes for the future. The mortgage wasn't simply financing a house anymore, it was financing an entirely new way of life. Suburbs expanded across the country. Shopping centers followed, schools opened, highways connected, growing communities to nearby cities. The idea of the American dream gradually became inseparable from owning a home. Homeownership rates climbed steadily throughout the post-war decades. For millions of families, a house became their largest financial asset. Equity accumulated year after year. Parents passed that wealth to their children. Entire generations built financial security through appreciating home values. It was one of the most significant wealth-building systems in American history. But as remarkable as this success story was, it contained a painful contradiction. The new mortgage system was opening doors for millions of Americans. Yet for millions of others, those same doors remained firmly closed. Because while government-backed mortgages helped create the modern middle class, government policy also played a major role in deciding who would be allowed to join it. The greatest expansion of homeownership in American history came with an invisible boundary that separated opportunity by race as much as by income. By the early 1950s, America looked like it had solved one of the greatest challenges in its history. The mortgage market had been stabilized, banks were lending again, construction companies couldn't build homes fast enough. Millions of veterans were buying houses. Suburbs were spreading across the country. For many Americans, it truly felt like a golden age of homeownership. But history rarely tells a story that is entirely hopeful. Behind the photographs of smiling families standing in front of new suburban homes, another story was unfolding, one that millions of Americans experienced very differently. The same federal government that helped make mortgages safer also played a central role in deciding where those mortgages would and would not be available. One of the most controversial parts of that system involved the residential security maps created during the New Deal era. Government agencies and lenders evaluated neighborhoods according to perceived lending risk. Areas considered financially stable received favorable ratings. Neighborhoods viewed as risky often received the lowest ratings. On many of those maps, the lowest rated areas were outlined in red. That practice eventually became known as redlining. In theory, the maps were supposed to measure financial risk. In practice, race often became one of the factors influencing those decisions. Neighborhoods with large black populations, or even neighborhoods expected to become more racially diverse, were frequently labeled as poor lending risks, regardless of the financial condition of individual families living there. The consequences reached far beyond a single mortgage application. Banks became reluctant to lend, private investment slowed, home values often stagnated. Families who could afford monthly mortgage payments sometimes found themselves unable to secure financing simply because of where they lived. Meanwhile, many white families gained access to FHA-insured mortgages and later benefited from rapidly appreciating suburban home values. Over time, those homes became more than places to live. They became family wealth. Parents borrowed against them to start businesses. They used home equity to pay for college. Children inherited houses that had increased dramatically in value over several decades. For millions of black families who had been excluded from many of those opportunities, that path to wealth was far more difficult. The transcript doesn't argue that the 30-year mortgage itself created racial inequality. Instead, it shows that the way the system was implemented allowed existing inequalities to become deeply embedded in the housing market. The effects didn't disappear when redlining was eventually outlawed. Neighborhoods shaped by those lending decisions often continued following different economic paths for generations. One policy, one lending map, one mortgage approval or denial. Those decisions accumulated over decades into enormous differences in household wealth. It's one of the reasons historians continue to describe housing as one of the most important engines of wealth creation in American history, not simply because homes increased in value, but because access to those homes was never distributed equally. Yet, even after these discriminatory practices gradually came under greater legal scrutiny, the mortgage system still wasn't immune to crisis. By the early 21st century, America once again believed it had mastered housing finance. Credit became easier, Home prices climbed rapidly. Lenders developed increasingly complex financial products. Many assumed the modern mortgage system had become virtually indestructible. Then came 2008. Once again, millions of Americans discovered that even a system built to create stability could become dangerously unstable when risk was misunderstood. The crisis looked different from the Great Depression. The causes were different, the financial products were different. But the lesson sounded strangely familiar. When housing finance becomes disconnected from long-term sustainability, even the strongest-looking market can unravel with astonishing speed. That reminder brings us back to the question we asked at the very beginning. Was the 30-year mortgage simply a natural evolution of banking, or was it something much more extraordinary? The answer says as much about America itself as it does about mortgages. Because the 30-year mortgage didn't just finance house it reshaped American society, transformed the middle class, and left behind a legacy that remains both remarkable and deeply complicated. Today, millions of Americans sign a mortgage without giving much thought to where it came from. It feels ordinary, routine, almost timeless. But as we've seen, there was nothing inevitable about it. For most of American history, buying a home meant paying cash, taking enormous financial risks, or depending on community lending organizations that could only do so much. The mortgage system we recognize today wasn't created because bankers suddenly became more generous. It was born from failure, from bank collapses, from mass foreclosures, from millions of families watching the dream of homeownership disappear during the darkest years of the Great Depression. Out of that crisis came a series of innovations that fundamentally changed the country. Hulk showed that troubled mortgages could be rescued instead of abandoned. The FHA made long-term lending practical by reducing risk for lenders. Fannie Mae created a secondary market that kept mortgage money flowing across the nation. The GI Bill opened the door for millions of returning veterans to buy homes and build wealth. Together, those policies transformed homeownership from something available mainly to the wealthy into a defining feature of the American middle class. But history is rarely a story of perfect solutions. The same system that helped millions of families build financial security also excluded many others through discriminatory lending practices. The same mortgage market that created unprecedented prosperity later contributed to another devastating housing crisis in 2008 when new risks went unchecked. That doesn't diminish what the 30-year mortgage accomplished. It simply reminds us that every financial system reflects the choices of the society that builds it. Mortgage markets don't appear by accident. Neither do housing booms. Neither do housing crises. They are the result of laws, institutions, incentives, and human decisions made over decades. Perhaps that's the biggest lesson of this story. The American dream wasn't created by a single invention. It was built piece by piece through policy, innovation, crisis, and compromise. Understanding that history doesn't just explain how Americans bought homes, it explains how modern America itself was built. If you enjoyed this documentary, we'd love to hear your thoughts. Do you think the 30-year mortgage remains one of America's greatest financial innovations, or has it become part of the housing affordability problem facing new generations today? Share your perspective in the comments below. And if you enjoy documentaries that uncover the hidden history behind the institutions, financial systems, and policies that shape the modern world, be sure to like this video, subscribe to the channel, and join us for the next deep dive into the forgotten stories behind history's biggest turning